China property sector will undergo structural transformation starting from this year. In this sector report, we actually did 3 structural studies looking at first how the valuation of this company will change when the economy is going through a structural transformation where they have become less reliant on fixed asset investment, where the percentage of gross fixed capital formation over GDP is reduced. We look at international case study. We look at studies from 6 countries, 9 episodes of history, where during the period where this country is undergoing such economic structural transformation, what happened to the PE valuation of these developers. Interestingly, after the first and second years of these changes, the PE valuation of developers, of the top few developers in this country, will be on average 15 to 20%. Now, if you look at the top developers in China, CR Land and Kohli, currently their valuation is only 10 to 12 times. What it implies from here is that there's still significant upside for the top tier names in the China property space in the mid to long term. No need to look for the small cap guys at this point in time. I think there's still value to be abstracted from the top tier China property names. The second study that we've done is we look at what will happen to the valuation in terms of NAV of the developers when they change their business model. Interestingly, if you look at again the 6 countries that we have studied, developers in these countries normally have net positive operating cash flows. It's very unique to China developers that they have consistent and a prolonged period of negative operating cash flow. And a key reason for that is that they have been very aggressive buying land and also trying to grow their sales. So as the developers start to adopt the new business model where they cut their land bank duration to just 4 years instead of a 10 years duration, operate on the positive cash flow basis, this will affect their NAV. Based on our simulation study, the destruction in NAV is about 20%. However, I think the net effect on what happened to the target price of the developers will not be as significant. The key reason is that as you cut your land bank durations to 4 years, I think you can actually apply lower target discount to NAV because there's greater certainty in converting your land bank into your earnings as well. So we think that impact in terms of cutting the land bank, changing the business model will be not that significant. On top of that, when you cut a land bank, actually your return on assets improve and there's less amount of resources tied as idle asset as well. The third point that we study in this report is that we look at the competitive edge of the developers. We look at a commercial property, investment property, the developers who have a competitive edge in terms of developing investment property. CR Land stand out as one, followed by Fanchon. The other competitive edge of developer, which is hard to replicate, is actually the even distribution of land bank in cities of various population size. This is pretty interesting because if you look at the sales performance of developer in 2011, the guys that do well is actually those guys which has very even distribution of land bank into cities which of very population size from 3 million onwards. Those developers who had too much of a land bank in cities with population size more than 10 million people actually do not do well. The key reason for it is probably because of home purchase restriction, but the other key reason is also that the large population cities tends to be crowded with developers. There's an oversupply situation, hence sales performance is more difficult. Our view is that this year the market condition is going to be relatively tough, but however, I think the government is already watching the downside. There's already cases where local government is actually relaxing some of the mortgage rates for first-time home buyers. The key is that government wants to bring back some of the fundamental demand and transaction volume. The key reason for that is that one, there's too much at stake if we have a big sharp fall in the property price. We're looking at 15% fall in the property price. If you look at the statistics, 37% of the household wealth is tied in real estate. The banks, although their lending to real estate sector is 20%, but as much as 66% of their collateralized loan is tied to the real estate. We're already seeing the negative impact feeding into the upstream and downstream business related to real estate. We've seen sharp slowdown in sales of TV, refrigerator, air conditioner. Overall, to wrap up, our topic in this sector is China Resources Land, Long 4, Evergrande, Coley, and Agile.